Welcome to your Mortgage Insider Update for this week. We are a few days away from the Jackson Hole Economic Symposium. The Fed chairman and all of the Fed governors will be in Jackson Hole, Wyoming, along with world economic figures from the European Union and China and all over the world to hear really the global economy, what is in store for us. And hopefully one of the things they'll recognize or discuss is the inflation that's now being caused by these higher interest rates at both the European Union Central Bank, the Bank of Australia, the Bank of England, and the U.S. Federal Reserve have all raised interest rates just in the last couple of weeks as we hope for any kind of news that a pause or maybe the end of this rate hiking cycle could be upon us as we see 20-year high interest rates. So let's check out the charts. Okay, this week we're going to start with the 10-year Treasury. It is up again 9 basis points today, and I have this chart spread out over the last year just to reiterate where we stand. So we are at the highest point in interest rates in 20 years when it comes to like mortgage rates specifically. The 10-year Treasury is our barometer and just a really simple way to just look at the yield or the rate of return to an investor that's going to invest in a U.S. Treasury bond. So that means their return on investment is going to be high, right? So back October 2022, we actually had peaked and only hit this level intraday on October 21st. Well, as we see today, it is still early in the going, but we have hit that and actually pierced just above that today. As we look a little closer, we can see that 4.33, that's our critical level. We are breaching that a little bit this morning on Monday. The Economic Symposium doesn't start till Thursday this week, so we are anticipating the run-up to this is a lot of the nervousness around rates, but also huge short positions. $800 billion in short positions are shorting the 10-year Treasury that we're looking at right here. When this yield goes higher, the cost to the investor to purchase the bond, so the actual price that they pay, works in reverse. So the price is at its lowest point for the 10-year Treasury, meaning that the yield is going to be at its highest point. So these short positions are going to play out over the next couple weeks, and we will see if maybe some good news from the Economic Symposium, good news being a turn in interest rate policy across the whole worldwide, would really could turn us around. In the meantime, we can see the mortgage-backed security prices are actually down, so this will help clarify as we look at this chart. As the mortgage-backed security price drops, that's pushing the interest rate higher. That's the opposite effect to the yield, like we were talking about on the 10-year. So along with that, we are hitting the low point in price, which means the highest point in yield in that same time period. It's been a year, last November and October, as where we hit those high points, and that was just shortly after the Federal Reserve chairman spoke at the Economic Symposium in Jackson Hole, August of 2022, and made it really clear that they were going to continue their policy to push interest rates higher. So from August to October, we saw the prices, really deflate. Interest rates, the actual cost, to us as consumers as we borrow money, and this being the U.S. mortgage-backed security, we're not buying these things, we're borrowing, right? So our interest rate's actually going up. So as we start this week, we can see mortgage-backed security prices are down, interest rates are higher. We're just going to hang on to our seats and see where we go. So we're going to come back to you next week with more updates as we find out if there is any market moving news. We will bring it to you next week. Hang on tight and don't let the interest rates get you down. Take care.